let me start on a new topic. And the material for it, I availed it, I think over a week ago, yeah? Around over a week ago. So it should be a material you have had enough time to read. Now that even last week on Thursday, we could not meet because of the chaos that were around the country. The topic which we are proceeding to, and I'll make the discussion on it very short. The topic which we are proceeding to, remember, is leases. So accounting for leases. And this is governed by two accounting standards. One is IAS number 17. And also when we look at IFRS 16. This also governs the accounting for what? Leases. And who can very briefly tell us what leases is about? Can I have somebody telling us very briefly what the leases are about? So who is this who will talk to us? I want us to make the discussion very simple, very short. Who will tell us what leases are about? Somebody. What is a lease? What is a lease? Somebody? Somebody, what is a lease?
It is where you rent out a property for longer periods.
Or renting of property for, Mariam says this is the renting of property for some times, a long period. Could somebody add something? Somebody else? Could somebody add something?
I believe.
Yes, 𝐷𝐸𝐻.
I believe that it is allowing someone to use a property by transferring things like risks that accompany the property and the benefits over a period of time, over some money.
So 𝐷𝐸𝐻 looks at it in terms of somebody transferring their property to another person. And as that happens, 𝐷𝐸𝐻 sees that some risks and rewards about the project transfer from the person transferring to the person to whom the transfer is done. Can I have just one more contribution? Kenneth says in the chat there is a contract where one party conveys his property for a specified period of time to another property. That's what Kenneth says in the chat, that somebody conveys the right of use of their property to another person, normally for a specified period of what? Period of time. And Kenneth says that there is normally a specified what? Payment. There is normally a specified payment. There is normally a specified payment. So there is normally a specified payment. So there is normally a specified payment. Anybody else who wants to contribute? Anybody else who wants to contribute? Alice Okelo says that the lease also involves two parties called the lessee and the lessor. So very wonderful contributions, yeah? Is there anybody else who wants to contribute? Before I come in and then have the specific definition of what a lease means. Any more contribution? All right. In a lease, we do have two parties. One party is called a lessor. And the other party, we call them the lessee. Look at those terminologies. One party, we call them the lessor. The other party, we call them the lessee. So these are normally the parties then involved in a lease. What happens is very simple. The lessor is normally the owner of a property. So that the lessor owns a property. In a lease agreement, what happens is very simple. The lessor gives the lessee the property to use for some time. And please, let's be very clear here. When the lessor gives the lessee the property to use for some time, what the lessor has given the lessee is what we call possession. That's what we call possession. Remember, possession and ownership are two different things. The lessor does not give the lessee ownership. The lessor gives the lessee what we call possession. When I talk of possession, this is the same as right of use. So the lessor gives the lessee the right of use over a property, yeah? And this kind of an agreement is what we call a what? A lease. Normally what happens is this. The lessee will have the right of use over the property for a specified time period. The lessor can give the lessee the right of use for, say, 5 years. When the 5 years are gone, when the 5 years lapse, what happens? Possession over the asset reverts back to the lessor. In other words, when the specified time period lapses, possession of the asset is given back to who? To the lessor. Mr. Kenneth Kibugi, please, you are interrupting the whole class. Mute, Kenneth Kibugi. All right. So I'm saying that when the time period agreed finishes, when that time lapses, then the lessee has to give back to the lessor possession over the asset. Now, this is what happens. Does the lessor give the lessee the asset to use for free? No. It can never be for free. The lessee has to pay to the lessor. The lessee has to pay to the lessor periodically. This could be like monthly. Periodically, what we call a lease what? A lease rental. What we call a lease rental. I want to give an example of a lease. I believe some of us live in rental houses. Your landlord or landlady is normally the lessor. And then you occupying the house is then the lessee. So you as the tenant is then the lessee. So this is a perfect example of what a lease means. When you enter into a tenancy agreement, that's the same as a lease what? A lease agreement. What does the landlord normally do? The landlord normally gives you as the tenant the right of use. The right of use. You will use the asset as, you will use the house as long as you have agreed with the landlord. You must pay to the landlord periodically. Periodically, in this case, monthly, in most cases, what we do call what? Rent. So the tenancy agreement between a landlord and a tenant is a perfect example of what we call a lease. And so, under the topic leases, we shall be looking at how this kind of an agreement is what? Accounted for. This is the thing. The landlord normally has ownership. The landlord normally has ownership over the asset, remember. And ownership comes with two things. Because of owning an asset, number one, there are those rewards which you enjoy for owning. Secondly, there are also the risks that you face when you own an asset. These two things come together with ownership. Whenever you own an asset, you experience the two. Remember, if, for example, you own a car, one of the rewards that you realize is the convenience of having that car. You can easily move compared to somebody maybe using a matatu. One of the risks you face is the risk of what? Accident. So risks and rewards are normally associated with ownership. Now, this is the thing. When as the lessor, you give the lessee the right of use over an asset, some of these things normally transfer. Some of them normally transfer. When you give the lessee the right to use an asset, then you transfer to the lessee some of the rewards associated with ownership, and also transfer some of the risks associated with what? With ownership. That goes without saying whenever the lessor gives the lessee what we call the right of what? Of use. For this reason, there are normally two types of leases. For this reason of transferring, for this reason of the lessor transferring to the lessee, risks and rewards, there are normally two types of leases. One is what we call an operating lease. So one is what we call an operating lease. Number two is what we call a financial lease. So operating lease, and then number two, there is what we call a financial lease. So if somebody were to ask tomorrow that discuss two types of leases or discuss the types of leases, then you'll be talking about one, the operating lease. Number two, what we call the financial what? The financial lease. All our discussions and the leases will concentrate on these two types of what? Types of leases. All right. When I talk of an operating lease, the first one, what type of lease is this? Now, this is normally a type of lease where the lessor gives the lessee risks and rewards associated with ownership, insignificantly, where the lessor gives the lessee risks and rewards associated with ownership insignificantly. In other words, when the landlord gives the tenant, and by the way, A perfect example of an operating lease is the tenancy agreement between the landlord and the tenant. When the landlord gives the tenant right of use over a premise, you realize that the tenant will always enjoy insignificant rewards associated with ownership. Again, the tenant will always suffer very insignificant risk. If you live in a rental house, for example, and the roof of the house you live in is blown away by wind, who bears the responsibility? As the tenant, that's not your responsibility to repair. The landlord shall always repair. So you find that in an operating lease, the lessee or tenant gets very insignificant risks and rewards from the lessor. What happens under the finance lease? Under the finance lease, the lessor will what? The lessor will enjoy significant rewards and also suffer significant risks. So under the second type of lease, the lessee will enjoy significant rewards associated with ownership, and the lessee will suffer significant risks associated with what? With ownership. A very good example. In the second type of lease, under the financial lease, you are going to have that the lessee, in case the roof of the house is blown away by wind, the lessee shall be responsible. That means the lessee has most of the risks and what? Rewards associated with ownership. Now, I want us to do this. I want us to look at the differences, the significant differences between an operating lease and a finance lease. Because I know the handout maybe does not make it very clear. But what are the significant differences between an operating lease and a financial or finance? Actually, just call it finance and a finance lease. What are the differences? Let's get to look at that. And you guys will need to write this. You guys will need to write the differences, because in that handout, they are not very what? Very clear. They are not very clear. So we can have this in terms of a table where column 1 will have the operating lease, and then column 2 we will have the finance. We will have the finance lease. And by the way, the finance lease can also be called the capital lease. So if you see capital lease anywhere, please appreciate that this is the finance The finance lease. Okay. What are then the significant differences between the two types of leases? Number one, lessor transfers to the lessee. Significant, or rather insignificant. In this first one, it is insignificant risks and rewards. Associated with ownership. So associated with ownership. The lessor transfers to the lessee in significant risks and rewards associated with what? With ownership. Under the finance lease, number one, lessor transfers. Lessor transfers to the lessee, significant, and you complete on the rest of that statement. Significant risks and rewards associated with what? With ownership. That's difference number one. Now, difference number two. That lessor manages and controls the asset. The lessor, the owner, will manage and control the property. What about under finance lease? Lessee manages and controls. Lessee is the one that manages and controls the asset. The lessee manages and controls the asset. Number three, that lessor repairs. The lessor repairs the asset in case of damage. In case of damage. Under this one, the lessee repairs the asset in case of what? Damage. The lessee repairs the asset in case of what? The damage. You know, the lessee is the client. The lessee is the tenant. But in this case, the lessee repairs the asset in case of what? Damage. Why? Because of this point number one, that the lessor has transferred to the lessee significant risks and what? Rewards. So the lessee is then liable, is then responsible for repairs, things like management, and remember, control over the asset list. Another one, number four, that lease duration. Lease duration, cover insignificant parts of the useful life. Part of the useful life of the asset. So cover insignificant part of the useful life of the asset. So the lease duration normally cover insignificant. In other words, like in the case of a normal landlord and a tenant. As a tenant, you'll occupy the house for a very small time compared to the useful life of the what? Of the asset. Now, under the finance lease, number four, lease duration will cover most of the useful life. Most of the useful life, and in this case, so most of the useful life of the asset. So the lease duration will cover most of the useful life of the asset. Actually, by most of, we mean at least 75% of the useful life of the asset. So lease duration will cover at least 75% of the useful life of the asset leased. So at least 75% of the useful life of the asset what? Leased. Point number 5. Point number 5, that ownership does not transfer to the lessee. So ownership will not transfer to the lessee at all. Ownership will not transfer to the lessee at all. What does this mean? As a tenant living in the house of your landlord or landlady, at no point in time, for whatever reason, in that tenancy arrangement, will ownership transfer to you. There is no chance of, in the tenancy agreement, ownership transfers to you, unless in a totally another arrangement where you want to buy the house. There is no chance of ownership transferring to the lessee in the case of the operating what? Lease. What about under the finance lease? Number 5, ownership may transfer. Ownership may. I'm very careful with my choice of words. Ownership may. In other words, it is not a must that ownership does what? Transfers. Ownership may transfer. May transfer to the lessee. At the end of lease. At the end of lease. Ownership may transfer to the lessee at the end of what? Lease. So these are therefore the differences between what we call the operating lease and then the finance what? The finance lease. And these are the characteristics of the two leases and their differences. Nani yako na swali to this point? Is there any question to this point from anyone? The lease, which is a complicated accounting for, the operating lease is just the lease between a landlord and a tenant. Normally, the landlord is the owner of the asset rented out. And the landlord recognizes that asset as theirs. The landlord receives rent from the tenant. The rent is an income to the landlord. To the tenant, the rent is normally an expenditure. The lease, which is complicated accounting for, is this one which we call the finance what? Lease. Look at the characteristics, ladies and gentlemen. So it's not a normal lease that we know. For that reason, we shall concentrate on how to account for the finance what? Lease. Let's look at the finance lease. So let's look at the finance or the capital. The finance for the capital lease. The finance for the capital lease. The finance for the capital lease. So finance or capital. The finance or capital lease. The finance or capital lease. We have said that under this lease, when you look at characteristic number 1, we have said that under this lease, the lessor transfers to the lessee substantial risks, and rewards associated with ownership. When this is the case, ladies and gentlemen, this lease shall operate in a manner as if the lessee is the one owning the asset. For it to operate this way, then we shall have that under the finance lease, the lessor will treat the asset as sold to the lessee. That is the first important point in this lease, that lessor treats the asset or property as sold to the lessee. This is the first important point. This is the first important point. The lessor shall treat the asset as sold to the lessee, normally at the cash price, or what? Fair value of the asset. Normally at the cash price or fair value of the asset. And what this means is very simple. The lessor shall report a sale. When you have something sold, then the lessor has to report a sale. The lessor reports a sale. And in fact, when the lessor prepares their income statement, the lessor reports this sale of this asset list. Allow me to make this very clear. In actual sense, the asset is not sold. However, we treat the asset as sold because of what? Because the lessor gives the lessee substantial risks and rewards. So when this is the case, the second point to note, the lessee capitalizes the asset. The lessee capitalizes the asset. The lessee capitalizes the asset. What does capitalizing mean? Somebody who remembers these things from your introduction to financial accounting. What does to capitalize mean? What does to capitalize mean in accounting, in financial accounting? What does to capitalize mean? The lessee treats the asset as theirs. Lessee treats the asset as theirs, so that the lessee will report in their balance sheet. When you look at the lessee's, but you know the lessee is the client, but the lessee will treat the asset as theirs. When you look at the lessee's balance sheet, when you look at the lessee's balance sheet, that asset will be one of the assets in the lessee's balance sheet. So the lessee treats the asset as theirs, and in fact, the lessee depreciates the asset. In other words, the lessee will report a depreciation expense on that asset what? List. The lessee will report a depreciation expense on the asset list, meaning that even as the lessee recognizes the asset in their balance sheet, the lessee shall recognize the asset at its net book value, which you know is cost, you less the accumulated what? Depreciation. Now, ladies and gentlemen, this is the thing. I want us to look at the lessor against the lessee. Against the lessee, number one, what do they report in their income what? In their income statements. What do they report in their income what? Income statements. The lessor will report incomes, whereas the lessee will report expenses. The question is, which incomes and expenses are these ones? Number one, the lessor will report an income in terms of sale of this asset leased. You know, we have said here that the lessor treats the asset as sold to the lessee. The first income that the lessor therefore reports is sale of the asset what? Leased. Secondly, the lessor will report a lease interest income. So the lessor will report a lease interest income. So the lessor shall report two incomes in their income statement. One is the sale of the asset leased, we have clarified here. Number two, the lessor shall report a lease interest what? Interest income. Now, which expenses does the lessee report? The lessee will report, the first expense is depreciation. You know, we have said that the lessee will capitalize the asset leased. In fact, the lessee will depreciate that asset that we have said here. So one of the expenses that the lessee shall report in their P&L is the depreciation what? Expense. Secondly, the lessee will report the lease interest expense. Meaning, in a lease, there will always be a lease interest. Very shortly, we shall talk about lease interest so that you understand how we determine it. But I'm saying, in a lease, there will always be a lease interest. The lessor receives it. So the lessor reports it as a lease interest income. On the other hand, the lessee reports the interest as an expenditure. Why? Because it is the lessee that pays the interest to the lessor. That's number one. In the income statement, that's what they report. Number two, in the balance sheet, in the balance sheet, the lessor will report an asset. The lessor will report an asset. What is this asset called? This asset will be called receivable. And don't worry about these things, I will explain them in terms of figures. The lessor will report an asset called receivable under finance what? Lease. Receivable under finance what? Finance lease. So the lessor will report an asset called receivable under finance lease. This is very simply the amount of money that the lessee will be paying the lessor over the remaining period of time, or the amount of money that the lessor will be expecting from the lessee over the remaining period of what? Of time. So receivable under finance lease. Now, this receivable will be divided into two parts. Non-current asset, and current what? Asset. So the receivable under finance lease, you will separate into non-current asset and current what? Current asset. That's all that the lessor will report in their balance sheet about this kind of a what? This kind of a lease. When we come to the side of the lessee will also report number one, an asset. Which asset is this? The leased asset. You know, we are saying that even though the asset is owned by the lessor, the owner of the asset is the lessor. But with the way the lease is structured, the lessee assumes ownership. That's why we say the lessee capitalizes this asset list. So the lessee shall report the leased asset actually say that at net book value. In other words, at the cost of the asset minus the accumulated depreciation. At the cost of the asset, you minus the accumulated now depreciation. Secondly, the lessee will report liability. The lessee will report liability. Which liability is this? Look here. The lessor has reported an asset that we call receivable under finance lease. I have explained that this is the money that in the future periods, the lessee will be paying the lessor. If the lessor calls what is receivable from lessee as receivable, the same amount, the lessee will call it payable or obligation under finance lease, or obligation under the finance what? Lease. So this obligation under finance lease is what the lessor, on the other hand, calls receivable under finance lease. So it's an asset to the lessor, but the same figure is a liability to the lessee. In the same manner that the lessor divides this into non-current and current, also the lessee will divide it into non-current liability and then current what? Liability. Ladies and gentlemen, I want you guys to go to your WhatsApp group. Go to your WhatsApp group and please access. I've sent a material with the 2 questions. I want us to look at the 2 questions, starting with question number 1. So let's go to the WhatsApp group and look at that question number 1.